So just to practice muting and unmuting, which some of you already have, let's just say a quick hello by unmuting, saying hi, and maybe high-fiving the people next to you in the gallery view on your screen there. Good morning. Hi.
Hello.
Good morning.
Good morning.
Hello, everybody.
Good morning.
Hi, everybody.
Good morning, everyone.
Hello.
Hi.
Hi.
Hello.
Oh.
Great. Thanks for doing that. I wanted to introduce myself. I'm Nicole Lezin, and one of the co-facilitators of CORE, which is convening this and other trainings. And I'm joined by
Nicole Young, the other CORE consultant.
We didn't plan this to just both be named Nicole's, but it does have its advantages. So welcome everyone. And we wanted to do a very quick overview of the CORE investments approach as we head into this session today. Some of you are already familiar with this, but the collective of results and evidence-based or CORE investments started out as a funding model from the City and County of Santa Cruz to support safety net services here in our county, and has really expanded over the last few years to become more of a movement to achieve equitable health and well-being in our county using a collective impact approach that focuses on results. So with the guidance of a steering committee and some of you on this call and many partners throughout the county, we have developed the CORE mission and vision, both of which have equity at the center. And by that we mean, by equitable opportunities for health and well-being, we mean that you wouldn't be able to predict in either direction the outcomes for people based on different characteristics such as race or ethnicity, income, sexual orientation, gender, etc. The CORE approach is based on a collection of these core conditions. There are 8 of them. They're all connected to one another and again have equity at the center. So we're thinking that many of you are connected particularly to one or more of these core conditions, but we really think the strength of this approach is that there's a ripple effect both in terms of successful outcomes, but also in terms of addressing gaps and inequities across all 8 of them. So that's all I'll say about CORE for now, but there's lots more material we're happy to share with you. One of the features of the CORE approach is the CORE Institute for Innovation and Impact, which is the umbrella for building capacity throughout our county and providing trainings like this one, and we hope many others as well. So stay tuned for more about that, but this session is under that umbrella, and we are very pleased to bring you this and other trainings, some of which have been practical, how to use Zoom kinds of things, or topical ones like this one, or other reactions to COVID-19. But we really welcome your ideas about other topics that would be useful to you. So stay tuned at the end of this session for what's coming up next. So with that, I'll turn things back over to Nicole Young to introduce our speaker today.
Great, thank you. And I'm so grateful. We're both so grateful to David Doolin for coming back to one of our CORE coffee chats. He was actually here a month ago when the Paycheck Protection Program and the Economic Injury Disaster Loan programs were just being released, and people were just trying to figure out how to even apply. And so he was one of our early guests early on in one of our coffee chats that provided some guidance and tips about how to apply for these 2 types of relief funds. And in the time since then, a lot has happened, and there have been a lot of I think lessons learned, or probably David will tell us things that people are learning every day about how to not just get the loans, but then how do you plan for them, especially with the Paycheck Protection Program loan. How do you set yourselves up for success so that you can have the maximum amount of that loan forgivables or forgiven? So very grateful to David. David is a local CPA who is a managing partner at Petrinovich, Pugh and Company. And some of you might know he's also the board president for the Community Foundation of Santa Cruz County. And that's actually how we got connected to him, through Susan True, who mentioned that David is very knowledgeable and knows the nonprofit sector well, So again, David, we're very grateful to have you joining us here today. And I'm going to now switch over to David's slides.
Well, good morning, Nicole. Thank you so much for having me back again today. I really appreciate the opportunity. It's great to see so many people here. And I don't think you showed it, but there was a response.
Oh, that's right. Totally
we
forgot.
already passed it, but I'll just describe it. But one of the questions was whether or not you've received the Paycheck Protection Loan, and 90% of the respondents of the attendees either had one in-house or had one pending, which to me is really good news, because that means that it's working. And especially in the nonprofit community, where so many of the nonprofits that I talk to and hear about, they don't have a really deep accounting department, and they don't have necessarily super strong relationships with bankers, which were the two things that really accelerated the getting the funding approved. And a lot of you guys are getting them approved, which means that, the system's working the way Congress had intended. And I think that's fantastic. I mean, I'm sure it could have done a lot better, but where we were a month ago, we had no clue whether or not we'd be where we are today. And I'm just glad to see that we're at least as far as we are today. So today we're going to talk about, so you got your payroll protection loan and you've been funded, now what? That's a question that's been on everybody's mind. In fact, a month ago, I was spending all my time with my clients dealing with how do I go get funding. And now I'm spending a heck of a lot of my time dealing with what now. So that's what we're going to talk about today.
David, can I interrupt you for just a second? We're getting some chats that you're a little bit hard to hear. I don't know if you can move closer to your microphone or...
I will move closer and try to increase the volume. Does that help? Hopefully that helps.
I think that's a little bit louder, but for all of you on, if you're still having any difficulties hearing any one of us, feel free to send me a chat and we'll send a signal to turn up the volume.
Sorry about that. You want to move to the next slide, please? Okay, so this is our disclaimer. The bottom line here is the top part is the most important part, and that is that things are changing rapidly, and this information is accurate today, but it's changing all the time. In fact, the SBA has issued 3 rounds of frequently asked questions. They've labeled each one of them interim final. If you have any idea what interim final means, let me know. But they will issue more, and hopefully we get greater clarity as things go forward. Next. Okay, so what we're going to talk about today, we'll have a brief general overview. Then we're going to talk about maximizing forgiveness, which is the best way to, the biggest advantage of this loan is if it's used correctly in a certain amount of time, you are allowed to have this loan forgiven, which treats it much more like a grant to you. And then the final thing is where we're headed on documentation. Okay. And I guess some people are still having difficulty hearing me. I'll just turn my volume all the way up, and I hope that helps a little bit. For most of you, Nicole, can you hear me okay?
Yeah, some people seem to be able to hear you. Some think it's a little muffled. I'll just encourage everyone to turn your own volume up as high as you can as well.
Okay. So the general overview, first of all, we'll start with number 2. And when we met last time and we talked about getting the loan, I think one of the first things I said is your banker is your gatekeeper. And And that's going to be the same thing with getting the loan forgiven and documenting the use of the loan to the SBA. Because the bottom line is that the SBA, as we said before, has 3,000 employees. There are millions and millions of these loans out there. And the banks are the ones who are essentially the monitors for the SBA. So really understanding what your banker wants is very important. Those of you with a local bank will find that a little easier because you'll have greater communication with them. Those of you that went online to some of the national services or with B of A or Wells Fargo, that's going to be a little more difficult in terms of getting real information from them. But at the same time, unless the information you submit is challenged, you should be just fine. But again, pay attention to that. The other caveat is that it's very clear that the purpose of this loan is to pay payroll. And so the requirements say that 75% of this loan must be used for payroll, health insurance, and pension contributions. That's regardless of whether it qualifies to be forgiven or not. And so what we're telling our clients is that be sure that you spend 75% of this loan for those three things, whether or not they qualify, whether or not it happens within the 8-week period or outside of the 8-week period. It's very important that 75% is paid for those three things. Okay? Next slide. Okay, so maximizing forgiveness, and we're going to go through a little bit of an example of this later. I think most of you received a spreadsheet that that we're going to talk about a little bit later on, but I'm going to describe it first. And so there is the date of the loan starts what's called the 8-week forgiveness period, and the date of the, or excuse me, it's not the date of the loan, it's the date the money goes in your bank. Okay, so the date you receive the funds, and normally what happens is you sign the loan the day before and you get it the next day, but some people are not getting their funding for a few days after that. It's very clear that the 8-week period starts on the day that you get the money. Okay? The next thing about that you need to pay attention to, and this is a question a lot of people have, and this is an area that we don't have a lot of answers. It says that eligible expenditures are amounts paid and incurred during the period. Okay, so paid is easy. That's something you wrote a check for. Incurred is not so easy. You know, generally you would think incurred means that you're covering payroll for the payroll that was earned by your employees during that 8-week period of time. But what happens if you get funded on day 1 and on day 5 you have a normal payroll which covers 2 weeks for a period outside of that 2-week period? We don't know the answer to that yet, and the guidance hasn't been given. But what I'm telling my clients, and what I think you should do, is include that in the calculation, even though it's outside. If you pay it during that period, include it in your calculation, and we'll see where it goes. You know, the other big question that comes up, and I don't know how relevant it is to a lot of the nonprofits, what if we pay our annual match to our pension plan contribution during that period of time? And you know, will that qualify? Because it's paid, but because it covers a payroll period that's so far out, or a period that's so far out of the payroll period, I'm encouraging people not to. If you can match the portion of the payroll pension contribution that would sort of be equal to that 8-week period, then I think that's probably okay. But again, we don't have guidance on that. Next slide, please. Okay, here's where things get a little more detailed. The first part is eligible expenditures consist of what they call the 75% expenditures, and the 75% expenditures start with payroll. Now, payroll is limited to $100,000 per person annualized. Again, that's not fully defined, but the bankers that I'm talking to are basically saying anything more than $83.33 per month allocated to any individual employee will be excluded from this calculation. So limit the amount that you include on your forgiveness calculation by employee to $83.33 per month. The next thing is state employer taxes. That does not include FICA or federal employer taxes. They are clear on that. The state employer taxes are the SUI and SUDA. Generally, by this time of year, that's a very small number, but it is includable. Also, your pension contribution, as I said, if you're doing a match with every payroll period, just go ahead and include that in there. That pension contribution is the employer portion of the pension contribution, not the employee's portion. And the payroll amount is the gross payroll. It's not reduced, so they are very clear on that, that it's the gross payroll during the period. So it does not, it's not reduced. There was some concern that it would be reduced by employee FICA or employee withholding. Actually, that's what the law says, but the SBA has said that they're not going to do that. And finally, you get to add to that health insurance. The combination of those things are what are considered the 75% expenditures. And when I talk about the 75% expenditures, I talk about it in two different ways. One way is in terms of the appropriate use of the loan, whether it's forgiven or not. And those 75% expenditures need to equal 75% of the total loan you've got. We talked about that a minute ago, whether it happens inside the forgiveness period or outside. The 25% eligible expenditures consist of rent, mortgage interest, utilities, internet and telephone, and gasoline if you have vehicles that you use, or I'm also including if you reimburse employees for gasoline, that you should include that on there if it's used for business purposes or for the purposes of your organization. Okay. Next slide. Okay. So once you have that calculation, and we'll go through that again in a minute, you have what they, during the forgiveness period, if you pay or you have certain reductions in payroll or full-time equivalents, you can have the forgiveness amount reduced. Now, those amounts still qualify for the 75%, but the amount that you end up getting forgiven will be reduced if you have these situations. One situation, and if you look at A and B on the slide, A deals with the rate of pay, and B deals with the number of people you're paying, okay? So the rate of pay, if your employees who are making less than $100,000 per year have had their salary reduced by more than 25%, then the cumulative dollar amount of that more than 25% will be reduced from the amount that you get forgiven. Okay. And then you have the FTE reductions. And this is by far the more most challenging part of the whole program. And I'm going to go back. I think I just got asked to repeat that salary reduction part. And it's a little complicated, but the bottom line is, if you have employees who make less than $100,000 per year, say they make $100,000 per year, and during this 8-week period, you went to them and said, you know, we can only pay you at an annual rate of $50,000 per year, half a year's salary. And so what would happen in that situation is, because they make less than $100,000 a year and their salary was reduced by more than 50%, more than 25%, then you'd have to do a calculation. In this case, it would be the amount in excess of 25% is $25,000. And that $25,000 would just be taken out of the amount that gets forgiven from your forgivable portion of your loan. Then I'm going to move on to the FTE reductions. And this is the most challenging part of the forgiveness calculation. And it's the only part, well, maybe not the only part, but one of the only parts that the SBA has given us no guidance on. So we're flying blind on this one, and it's so we'll just have to wait to see where the guidance comes from. But the bottom line is, there's a ratio that you're calculating here, and the numerator of the ratio is your average number of full-time equivalents during the 8-week forgiveness period. And the denominator is one of 3 numbers: your number of average full-time equivalents between February 15th, 2019 and June 30th, 2019, or January 1st, 2020 to February 29th, 2020, or this third part of it, which is June 30th, 2020. And basically what they're saying is, if you restore your number of full-time equivalents by June 30th, that will be considered appropriate for the denominator. And so in the end, if there's been a reduction, you've had a reduction in force during that period of time, you just do the math. And that's what I'm telling my clients, and we'll see where it goes from here. But you just do the math. And well, let's back up for a minute. How do you determine full-time equivalents? There's a million ways you can determine full-time equivalents. All I'm suggesting is, if whatever method you use to determine the average full-time equivalents during these periods, that you're consistent between the numerator and the denominator. Okay, so you don't, if you, for instance, some of my clients are taking the total number of hours worked divided by a 40-hour work week, divided by the number of periods, and that's the number of full-time equivalents they're getting. There are a whole bunch of other ways that you could calculate that. All I'm saying is, without further guidance, go back and use the same method to determine the FTE during the 8-week period, and for one of these other denominator calculations. And the best one of those denominator calculations, are the one that puts you in the greatest percentage forgiveness, is the one that you're going to want to use. This is going to be an area that, you know, what I can tell you is that banks don't know how to do this calculation. They're going to be relying on you. And so be as explicit and detailed as you possibly can, and be consistent in your calculation. Then moving on, next slide. The final thing is, okay, well, we've got all this stuff. How do we keep documentation so that you can turn them into the bank in an appropriate way? Number one, we're telling people to use a separate bank account. Not everybody's doing it, but from my perspective, if you put the money from the payroll protection loan in a separate bank account and take the money out to fund the eligible expenditures, that will give you the best documentation that you're using it for the purpose that the loan was intended. And I think that when I'm reading from other CPAs and other people around the country, that's what they're suggesting. So if you have a challenge doing that, I can't say one way or another, but that's our best way to do it. Barring that, I would just be very deliberate about how you document the use of the funds to make sure that you meet the requirements of the loan. As if you have a separate bank account or not, what I'm also suggesting is that you keep a spreadsheet, which is very similar to the one that I provided, that or something like it, that documents the expenditures during the 8-week period. And for each expenditure during the 8-week period, attach detailed backup of what you spent the money on. So if I have a separate bank account, then what I would do is in week 1, if I had a payroll, I would put the amount of the payroll in that spreadsheet. I would take a copy of the payroll run. I would show the total. Yeah, so if in week 1, for instance, I had $25,000 of eligible payroll, I'd take a copy of the, say you use ADP, I'd take a copy of the ADP report that totals up to $25,000, and I would include that in there and put it in a file and have it ready to submit to the bank when you do that. When I did my 401k match, I'd take a copy of the detail that supported that amount of money. A check, if you write a check, put a copy of the check in that file along with the detail backup, and again, put it in a file, be ready to submit that to the bank when you get to the end of this 8-week period. Can you go back? Just want to make sure. Oh yeah, and so keep that file with a copy of the payments made, and attach that spreadsheet to a detailed backup in the file folder. And whether or not you have to upload it to a bank portal or deliver it to your bank, that's what I want you to submit at the end of the 8-week period. They're also going to ask for an FTE calculation, very similar to what we talked about. As you're going along, I would keep a documentation, whether it's a, from monthly payroll records or from your, from the listing of employees on your, the detailed backup you submit for that 8-week period. It doesn't really matter, but you need to give them something that they can tie to so that you're able to determine the amount of the full-time equivalents during all those periods required. And then finally, if you have a reduction in pay, I would do that calculation as well, very similar to what I talked about. Okay, so now let's go through an example, and again, the spreadsheet. So this is what the spreadsheet is what I'm providing to my clients when they get one of these loans. And what happens is if you fill in that $150,000 in the upper left-hand corner, that sort of carries through the overall spreadsheet as expenditures are incurred. And what I suggest you do on where it says date of the loan, what I'm having my clients do is fill in the actual date the money got funded in your account. And actually, you know, the SBA hasn't given us complete guidance on that. It's not clear if they fund it on a Tuesday, that the end of the 8-week period is Monday, 8 weeks later. That's what I'm assuming. That's the most conservative. It could be if you fund it on week 1, it just carries throughout an 8 business week period. I'm not suggesting that you do that, but we may get further details on that going forward. So what I do is I look if it's, you know, the date of the loan is the date funded, and you put that date down there, and then you go out and where it says end of the 8 weeks, I have a specific date on there that is the day before 8 weeks later. So it's essentially the end of the 8-week period. And then as you see the eligible payroll amounts, what I'm having, again, people do is project on day 1, this is when I'm going to pay my payroll, this is how much it's going to be, and for each of the other categories, this is when I'm going to, you know, pay my rent, it's due on this date, and so on and so forth. When you get done, if you look at the right-hand corner, there, or the right-hand column, it says percentage. And if you look in this case at the combination, I should have put a subtotal in, but I just didn't. But if you look at the combination of eligible payroll, 401k match, health insurance, you add those up, it comes out to 78%. So that's an important calculation, and so we have that there. We've met the 75% requirement, and if you look at the very end where it says a minus 5,000, we've used more than all the funds available to pay for eligible expenses during the 8-week period. This actually rarely happens because of the calculation, but I made it so it did in this case. And we've met the 75%. So, you know, this is probably an ideal situation for somebody. So what I want to give you an example of is the reductions. And so in this case, let's say, for instance, there was 0 payroll in week 1. So just, yeah, perfect. You can see that that now comes out to 74%. Okay. And so one thing I'm going to suggest is that your very next payroll period, that you make sure to use whatever's left from this payroll, this $20,000 in the lower right-hand corner, where it says that's what you have left. Make sure that in the next payroll you use that for payroll purposes. Okay, so not there, but I'm saying outside of the 8-week period, because that way you'll know for eligibility you would have used the loan appropriately for 75% for payroll. But you also know that your forgiveness amount is going to be reduced because you didn't meet that 75% requirement. And the first calculation of the reduction is, and this starts to get a little bit more detailed, but if you were to take the 75,000 plus the 6,000 plus the 15,000, okay, and that total is 96,000, right? And you take that 96,000 and if you divide that by 0.75, that amounts to $128,000. Okay, that $128,000 now becomes the maximum amount of your loan that's eligible to be forgiven. So you have a $150,000 loan, and because you weren't able to use it all for payroll during that period of time, then that $128,000 is the best you can do in terms of forgiveness, which is fine. It just means that you're going to have a portion of your loan that's not forgiven, which means that you'll have to pay it back over the next 2 years at 1% interest. Okay, and then from that $128,000, you need to look at the, did you reduce the payroll of people making $100,000 or less by more than 25%? And let's just say that going back to our previous example, we have $25,000 of that. And so that would further reduce that $128,000 by another $25,000. So you'd be down to $103,000 that could be forgiven. Okay, you don't have to fill that in, but I'm just continuing the example. And then finally, you go to the FTE calculation, and let's just say we did reduce our number of employees, and our number of employees went down where we're at 80% of FTE. That's the best we can do. Then we take the 128 minus the 25,000, and then you further reduce that by your 80% FTE, and you get to somewhere around $83,000. That's again, it's not a bad thing necessarily, but that ends up being the amount of the loan that you get forgiven, and the rest of it you'll have to pay back. And I'm sure I've lost a lot of you along the way, and I'm sorry for that, but this calculation is not easy. So I just wanted to walk through this example really quickly, and that's pretty much what I had to present. There's probably a number. Oh, let's see. I'm trying to remember. There were a couple of questions that came in advance. One was about the FTE, which unfortunately is not complete, but I gave you my best that I could give you so far. There was a question, and it was similar to another question we had in the last presentation about if we're getting grants to fund payroll, how do they go into this calculation? And that's sort of out of my area of expertise, but one of the things that came up is that they're going back to their funders, and they're requesting that in this period of time at least, that the amounts of grants or the allocable amounts of grants are used for general operating purposes, so that they can get use the loan for the appropriate purpose during that period of time. There's one more thing that's not in my slide presentation, but if you did apply for an EIDL and got the $10,000 grant, $10,000 grant, and subsequently get a payroll protection loan, you need to use $10,000 of your payroll protection funds to repay that grant, and that's included in the forgiveness calculation.
Thanks, David. We have a request for your PowerPoints, a couple of requests for going through that example one more time, and then a bunch of specific questions that I'm trying to organize into groups. Would you mind walking through that example one more time? Just to...
Yeah, and this is, I think we started with a perfect example, and we don't want to do that because this really illustrates the calculation of forgiveness in a period when you don't meet the 75% requirement for payroll during the 8-week forgiveness period. So let's just say that we have this scenario here where the combination of payroll, employer taxes, 401k match, and health insurance comes to $96,000. Okay, so step one, and Nicole will resend the spreadsheet if you want it, but step one is to take that $96,000 and divide by 0.75. Okay. And by the way, let me back up for a minute and just say that the SBA has not provided us with a calculator that does this. So this is my best estimate of how it's going to work. And again, the bank is going to give you guidance in the end. And I'm assuming it's going to look very similar to what I'm talking about right now. So you take that $96,000, you divide by 0.75, and that gives you the max amount of forgiveness you can get. And you can see that that's less than the $150,000 that you got in the loan. Okay. So the next step to further reduce that forgiveness is to look at the reductions related to rate of pay and the reductions related to FTE. And the rate of pay reduction is just a dollar reduction. And we used an example where you had one employee and that employee salary got reduced by 50%, and the amount over 25% was $25,000. So that $25,000 comes out of the forgiveness piece of your loan. So if you, in that case, you take the $128,000, subtract $25,000, and you're able to get $103,000 forgiven. That's the max. And then you go to the FTE calculation. In our case, we decided that the FTE reduction amounted to 20%. In other words, you have 80% of your FTEs over that period of time. And so we're just saying that if you take your 103,000 multiplied times 80%, then you get a forgivable piece of something like $82,000. Okay? That's the calculation. Now, the other part about this that's really important, and I think somebody pointed that out, is one of the requirements of the loan is 75% of this loan gets used for payroll. Okay? So we need to take whatever's left on that loan. In this case, there's $20,000 left on that. There's $20,000. We need to use all that to pay for payroll to meet the 75% requirement, but you use it outside of the period. So you don't get it forgiven, but you need to pay payroll with it. Okay?
So David, you've probably seen a lot of more specific questions surfacing.
Yes.
So there are some related to timing.
Uh-huh.
So one related to timing is if the loan was received as a check instead of a direct deposit, does the clock start when the check is deposited in the bank?
Great question. No, I would say it would be the date on the check.
The date on the check. And there's another question about the date of payroll. So for example, if the person who asked the question had run a payroll on May 4th for the last 2 weeks of April, but received the loan on May 1st, what are the effects of that timing?
Well, again, that hasn't been completely spelled out, and that gets back to the paid and incurred. What I'm suggesting is that there's not much you can do about the payrolls that got paid just before.
Okay.
But what I'm suggesting is the payroll that happens sort of would normally happen just outside of the ending period of the 8-week period. I'm having them prepay that so that it gets included in the 8-week period. So for instance, if you have a payroll that would normally get paid on Friday, but your 8-week period ends on Wednesday, I'm saying pay it on Tuesday. Okay? And even if it covers a period that's just outside of it, that's the way it goes.
We also have some questions about the coverage for different things. So for example, for utilities costs, could there be HVAC maintenance or fire alarm services? What about mileage?
Yeah, so again, no guidance. I would say that for HVAC, they're really talking about utilities. So it's a check that you write to a utility company.
Mm-hmm.
So if you have somebody come out to service your HVAC, to me, that's not an eligible expenditure.
Okay.
Mileage, that's a great question. I would include it and just see what they say.
Okay.
Yeah.
So there's some questions that are a little more complicated than trying to capture in a nugget here. So I'm trying to see if there's some we can group. Laura, Marcus, you had a question about unemployment insurance. Do you want to unmute yourself and ask that one for David?
Yeah, sure. Thanks so much,
Right. Thanks, Laura.
Nicole. Yeah, thank you so much. So hi, David. Thank you so much for this information. It is a lot to take in, and I would love to hear how we could potentially use your services after this webinar, obviously paid services, to help guide us. So I hope you'll give your contact information out. But my question was in regards to our unemployment insurance, and the reason I bring it up is because we pay through a non-state entity. It's called UST. I'm not super familiar with the program because I'm not dealing with payroll directly, but so we're paying into this fund basically, and we manage the fund, and it's held on our balance sheet as a liability. And right now, of course, that fund is being depleted very quickly due to the number of people we've had to furlough and lay off. So my question is, I wonder if any of those unemployment insurance related claims could be potentially covered by this.
Well, the law says state, or the guidance that's been given so far, actually it's not specifically in the law, but it says state employer taxes. So
right.
I don't think that would be eligible.
Okay, even though normally unemployment insurance is a state tax?
Yes. I mean, I don't know the answer to that, but I'm just, you know, and again,
okay.
when you, and this gets back to your discussion with your bank. I mean,
right.
if you have a question about something, I've seen on the loan side, I've seen applications include so many different things that I did not think were going to be eligible, and they got funded. And so, you know, I would include them. I just saw a question about workers' comp, and workers' comp is not included in the calculation.
Okay, thanks for that.
Thank you.
Thanks, Laura. Let's see, we had questions about someone who's restoring all of the employees, the same number they had prior to applying for PPP. Do they really need to use the FTE calculations, or is that only relevant if you're not restoring all of your employees to full-time and full pay?
The FTE calculation's unrelated to, so you do need to make that calculation, but if you restore by June 30th, that's one of the denominator numbers that you can use. So, I think, again, we don't have a lot of guidance on the FTE side, but it does say restore by June 30th. So I think that meets the requirement.
Okay. And this was sent to me privately, so you may not have seen it, David, in monitoring the chat, but how about determining the FTEs of pre-AB5 contract workers? And in this case, for example, a set designer who's now an employee, but these are people who might be paid a flat per project fee for their work, regardless of their hours.
Yeah, well, independent contractors, they've made it very clear in this process that they're not included.
Mm-hmm.
So would you, and that's an interesting question. If they've been replaced, actually, if they've been replaced by an full-time equivalent, then that would actually help your situation. If they've been replaced, if a full-time equivalent's been replaced by an independent contractor, that's going to hurt you.
Okay. What about rent that's paid quarterly?
I would pay it during the 8-week period.
Okay.
Yeah. I mean, so it gets back to paid and incurred. So the easy one to calculate is paid. And they're also, for some of these calculations like rent and utilities and phone services, those need to be related to plans that were in place in February of 2020. So if you just moved into a building, or if you just renegotiated your lease, I think they're trying to get people from, doing crazy things with their leases to get more forgiveness. So you just need to be cognizant of that. Okay.
So I think I may have misphrased the actual question. So they were the people I thought were contract employees were actually full-time employees. Julie, do you want to weigh in? You're muted, Julie James.
Yes, they prior to January 1st, they were contract, but now from January 1st, they're employees. So how do I compare the look back periods to know which one to use in the calculation? How do I determine their FTE for January, February, when they're paid a flat fee regardless of hours? I'm trying to figure out so that I know that look back period compared to the other look back period to know which one is going to benefit more.
Simply, and the answer is I don't know the answer to that. That's a great question, but I can tell you that if you have, because of AB5, you've taken independent contractors and converted them to employees, you're in the best possible situation because you've increased the denominator. Okay. But
not compared to now, because I don't have any shows. I have none of those people. I only have my core employees. So I have no actors on salary. I have no designers even on salary. So my any look back period looks worse for me.
Yeah, well, and you're like restaurants and other things that aren't open and other services that, I mean, hopefully we're going to get something that allows you, because you were required to be closed, some greater level of forgiveness, a greater period of time or something like that. But yeah, right now it's not pleasant.
But so if we're stuck with what it is right now, do you have a suggestion of how to determine the FTE for people who are paid still, even as an employee, they're paid a flat rate per their union contract for a project, regardless of hours? They might work 100 hours in 2 days. I don't know. we don't determine that. We just pay them a flat rate. What's the best way to determine the FTE for those kinds of employees?
Well, if I were to do it, I'd just use a reasonable method. I'd say, look, these guys I'm paying them as if they are a full-time equivalent employee or a half-time employee, and that's what my flat rate suggests, and that's what I go with. I mean, you just got to come to a reasonable conclusion.
Okay.
I know we're running really short on time and there are a lot more questions. One is mortgage considered rent?
It's not rent, but the interest on mortgage payments, the interest piece is a forgivable expense.
So the interest on the mortgage is considered forgivable expense. We've got some people still confused about the 75% calculation on the spreadsheet.
Yeah, and that's because it's a very complicated concept, because the 75% is used in two different places to mean two different things. The 75%, the requirement that 75% of your expenditures of the loan be used for these three payroll related items is one calculation, which is that's of ultimate importance, but that's not related to what does or does not get forgiven.
Okay.
So it's really important that you sort of separate the two, and the challenge is that it's 75% used two different places, but they're for two different calculations.
Okay, thanks for that. So we're in our final few minutes here with David, but we'll try and collect the rest of your questions that didn't get answered today and see if we can distribute them in a document format after the call. Just want to thank David again for taking the time to try to help us make this a little less murky than it already is. And I know people are facing a lot of complicated and unique situations for each of your payrolls and each of your changes that you've gone through for the last few months. So we'll keep trying to organize sessions like this and answer as many questions as we can. We have collected them in the chat. We have another chat coming up next week, but it won't be at this same time. We've been normally doing them Tuesday mornings at 10, but it's going to be in the afternoon from 2:30 to 4. We'll get some notifications out in the next day or so, and that's going to be a longer conversational format to talk about some of the racial equity issues related to COVID-19. So we hope you can join us for that. And then we'll have the series continuing weekly with the 10 o'clock slot, except for next week. So we'll keep communicating about all of these topics. We really appreciate your joining us today and submitting your questions. We will do our best to get those answered in some way. So thanks, be safe, hang in there.
Thank you very much.
And thanks, David.
Yes.